Hi everyone, my name is Vess Rusev and this is episode number 10 of the East Auckland Properties Show. Today we're going to do our monthly market update with Brandon from RFI Mortgages. Morning Brandon, and thanks for taking the time.
No problem, always a pleasure, thanks.
Last time we had our market update and we said we have to do the next one after the election, so it took a while, 2 months.
That's right.
But we have a completely different political landscape, and this is the main thing that we're going to discuss today. But let's first start from the global markets and see, is there any reaction on the side of the global markets towards the political change and the government change here in New Zealand?
Yeah, well, for sure. I think the only change that I've really picked up in terms of global acting on New Zealand is the change in the dollar. So that's against the US dollar as well as the Australian as well. We've seen the value of New Zealand dollar drop a little bit. Mm-hmm. My interpretation of that is probably a little bit of a knee-jerk reaction in regards to the change of government too. Even though majority of the country via an MMP system voted for this government, for some reason everyone interpreted it as being a step against what everyone expected from New Zealand as well, so that's why we see the change there. So look, I'm really expecting to see that probably stay the same for a little while at the moment now, just because there's still a bit of uncertainty around the projects that the government's moving forward, and if us as Kiwis don't really know, then I guess we're not going to really be able to dictate it to everyone in the world as well. So yeah, look, I'm picking that we're not going to see much other movement in terms of global, so that means interest rates are probably going to stay the same too. And yeah, I think the only other global aspect is potentially the lockout of foreign investors too, which may or may not impact things depending how the capital actually comes into the country.
But my other question is something that everyone is asking me, probably even more you on a daily basis, interest rates. How do you think that the current government or the current political situation will affect interest rates?
Look, if I'm going to pick anything, I'm picking it to stay. I say with the caveat that if I knew what interest rates were going to, there's a difference between guessing and a difference between knowing. If I knew what interest rates were going to be doing, I'd be doing a completely different job. I'm guessing, so it's a guess, I'm going to guess that they're probably going to stay. I don't see much change at the moment. Banks have become a little bit more competitive since we last spoke. It's late in the piece in 2017. People are going to start heading away for holiday too. We're not going to see a huge amount of new lending, I don't foresee, being drawn down. New lending in New Zealand drawn down was actually significantly lower in September. So that was a very, very poor month for new lending being drawn down in New Zealand. So look, I'm picking the interest rates to stay. The banks have become a little bit more some of the banks have become a bit more competitive.
In what regards?
In interest rates. Interest rates dropping a little bit from the banks, but banks are now pricing interest rates and for investment properties and owner-occupied properties different. It used to be done by a couple of banks, but now we're really starting to see it show that there is a significant difference in the pricing of an investment property versus an owner-occupied. It used to be based on LVR. And obviously the more equity that you have on the property, you're at a better chance of getting a low interest rate, but at the moment now there's other things like interest-only terms and investment property, or your overall relationship looks like with the bank, so they're taking a few other things into consideration. So
Okay, what type of clients are active on the market right now?
So I'm not really seeing a lot of people making a move in the market unless they really have to. So people who are those kinds of people I'm talking about are maybe people who are upgrading the family home to move into a different school zone. That's quite common, especially this time of the year, getting ready for next year as well. Kids go to college, kids go to intermediate. That's a move people sometimes make. If they can keep the investment property, then they'll try to do that, which is a great move. If they can't keep their current home as investment property, I should say. Likewise, it's more so the long-term players in the game. I think we're going to start to see the old money crop back up again. What I mean by that is that's people who have a bigger plan in place, who are not playing, say, a buy and flip sort of game where capital gains doesn't matter to them. They're holding for 7 to 10 years, waiting another cycle, because there might be some people who are selling property who have to sell a little bit less than what the market currently says. So in that instance, we're going to see people who are going to get ready to build on those properties. So I'm picking some areas where we've got change in the residential and the zoning of the properties. So skilled developers, people who understand the zoning rules, etc., the unitary plan, they'll be buying those properties to hold them for 6, 7, 8, 9, 10 years. So those are the kinds of people that we're seeing active in the market at the moment as investors.
Oh, that's interesting. And what's your opinion with regards to the new or the proposed programs from the government?
I think there's a lot of positivity that I have for it. I think it was pointed out the other day. I did read this elsewhere in the media as well, that intentions are great, and I think that's something that we've really seen from both potential governments as well. Both governments would have had to have walked the talk now, and I guess that's what we're going to see next. So I think the proposed programs look good, and I hope that we can execute on them. And the two that stand out to me is the Kiwi Bill, and then also the proposed rent-to-buy schemes as well. That I think are interesting a lot. It's causing a lot of interest in people at the moment.
Okay. So, do you know any more details?
I think everyone's getting left a little bit in the dark at the moment. What we know about Kiwi Build is what the proposal is, what the end goal is. It's over 10 years, 100,000 affordable homes in the country, 50,000 in Auckland, and 50,000 outside. So we know the implications for the price is about 500 to 650,000 make it affordable in Auckland. And in the regions we're looking about 450, I think, is the mark that they set. So 50,000 then for 450, 50,000 for 500, 650. But the budget announced for the project was about $2 billion. So the numbers don't quite stack up there. There's a bit of a deficit in terms of the government being able to fund it all privately. So I wonder what kind of implications that's going to have to fund it publicly. I wonder what kind of private implications it might have. $2 billion, you're only going to be able to stretch to build, a few of the houses in 1 year. How are they getting the money back out quickly? Are they going to make it easier for private developers to develop these new houses? And I think that's where we're going to see. There's probably going to be a lot of discussion around that, how the government can support people to do the development. Because with $2 billion, they wouldn't have the money. I don't see how they could do it. They wouldn't have the money to finance those projects themselves. And support, I guess, the next topic, which is the rent-to-buy stuff. And it's a common term. It's a common idea for people who've looked at buying a property. They don't quite have the equity. Rightfully so. It's what it supports. And people who fit that sort of bill might be people who are young professionals just moving out of home. People who might have gone through some event where they don't have the cash up front. It's not normally termed a rent to buy, but usually it's a lease with an option to purchase. So it's two separate agreements. You have the option to buy it further down the track, and you pay for that option up front, and then you have a tenancy agreement. So you end up with two pretty lateral agreements, which I think will be pretty interesting to look at in the future. You got to obviously stick to your tenancy rules, etc., and be a good tenant, but you're working towards buying the home and owning it one day. So the day that you move in, you won't own it directly. So again, there are a lot of questions around that. They used to have these projects. Now it's actually the first time that my family bought in New Zealand. So that was in Dannemora, Chapel Downs, actually. So my parents, their first home was actually a rent-to-buy property.
Was that in the 80s?
No, this is 2003. So it wasn't that long ago, but for some reason, everyone's forgotten it. And I wonder how they're going to bring it up. I mean, they could enter into this with the developers, but then obviously the finance becomes an issue because there's funding difficulties with the developers right now. So it's a good idea. in the finance industry, I'm struggling to see where the finance is coming from without it being very creative and without it involving a lot of the private sector as well, which which is a good thing. But hey, look, if we can get people into homes, their own homes, I think that's positive as well. So I'm all for it, provided we can execute.
Yeah, there was recently released one of the leading economists on the market. There was a report. I'm going to link it in the description of this video below, so you can download it and read it further. What's your take on this?
So I guess we're talking to Tony
Alexander.
Sure.
Yeah.
So look, what Tony said, I think it's pretty interesting. He pulls up some pretty interesting points in there. The one that he steps on that I found pretty interesting. It was surprising to me. I think surprising to most people. Is the increase in house prices in the national government, which is 16 terms. I wrote it down here. It was about 9.2% per annum. It was 12 terms. Sorry.
Yeah.
This is from 1963, and then the 6 terms, 16.8% through the Labour-led government. I thought those were pretty interesting figures, and I think it goes against, and it does go against the grain, and it just goes to show how different people perceive the market as well. And this is obviously the perception that we went into under a Labour government or Labour-led government, is that what's going to happen to house prices is a big issue. And I think people preemptively thought, oh, well, it's going to drop, it's going to decrease. These statistics talk otherwise. But then we also got to think property behaves in certain cycles, and that doesn't necessarily follow the same political environment. For example, I think Labour were at the head of the ship when we went through the last peak anyway, which is probably one of the biggest in quite a while if we look at the history. So, and their numbers are probably a little bit more biased towards an upward trend anyway. So yeah, look, I mean, you take everything with a grain of salt. I think it's that these figures actually aren't meant to predict what's going to happen in the market, but again, how people went into this Labour government thinking how it might behave, but actually the facts speak differently under other labour markets. So I'm not saying that the Labour government is going to increase the price of housing. They're actually trying to maintain it, and they may well do. So so look, I think it's good, and I definitely recommend that anyone should check out that report. There's a really nice, if you're linking the right one, there's a good full page about how many trees people can plant as well. So if you're interested in that.
Okay, and then can you tell us about some cases with clients that you have at the moment that are interesting or will help?
Sure. Yeah,
someone?
There's two that come to mind that I can think of that I think reflect the current market conditions. Like there should be some people out there who are either feeling the same way or either been thinking along the same lines. Is one, people still buying a family home. That's something that people will always want to do. They're not necessarily owning a home is generally more important if they understand how the market behaves. They know it's going to go up. They know it's going to go down. I've had clients who bought homes in the 80s and 90s telling me that they bought the home for $70,000. Everyone thought that they were nuts because the house was worth $70,000. They paid $80,000. Everyone thought they were nuts paying another $10,000. And now we're in 2017. The house is worth over $2 million. So that question of who's nuts now pops up, and that it's time in the market, not timing the market. That's most important. So people are still going to buy the family home. Great client example I can think of is a client could only get an approval at one of the banks for 20% deposit, not quite fitting the bill for what they wanted to be able to purchase. We got them deposit, we got them approval at 15% deposit. So banks are still willing to do that. It's about what funds are available to lenders, how many people they've already lent to, because they've got their budget, how many low LVR or low deposits they can lend out based on. And so it's just making sure you check the options. One bank down the street might say, oh sorry, we're going to need you on 20%, but next door might say, hey, we'll do a 15%. So it's wise to review your options. So first example, 15% deposit for a client. Now they can go out shopping, buy the family home that they want. And then secondly is the upgrade, people moving for school zones, people needing to move to a different area for work, etc. Actually sitting down and crunching the numbers, it might make better sense if you have a long-term approach to purchasing property and holding property and growing wealth. It might make sense to buy and hold the next property, turn your current home into an investment, and then buy the new family home as well. So there are a lot of benefits currently that people can have via tax, in terms of wealth development too. I think you need to see the right professionals to obviously discuss and examine. But when you sit down and nut out the numbers, it ends up, the commitment doesn't actually look as strong. I mean, it stops you from doing things like, rather than dedicating your full borrowing power to a family home, having 2 assets, and maybe not spending as much on a house with a pool, maybe a house with with every bedroom with an ensuite. You've probably seen some really nice houses, but it makes you think a little bit more wise about what you do with your borrowing power. I think reviewing the options if you're looking to upgrade and keep your current home, perfect scenario. A lot of Kiwis do it, and I think it's a really good step. It's the next step up the ladder.
Yeah. Okay. So I had a very interesting case the other day. I was with a client, and he's planning to do some moves in the near future, buying another home and selling his current property. So I asked him, have you spoken to a mortgage broker just to get a little bit of advice on what's going on in the market? He said, no. What I usually do, I just go to the branch manager of a bank, talk to them, and they give me the best rates. Do you think that's the best way to go if you want to?
No, never. And the reason being is because, you got to pick someone that you trust. That's the main thing, right? And I think it's very, if you're basing the relationship off of like interest rate movements, something outside of the actual relationship, then yes, I think potentially, I think there are a few things that might have been done wrong on both sides in that instance. For myself, I never sell based on the rates. For myself, there's not a strong enough reason to have a relationship with someone to say, I want to look someone in the eye and say, hey, you know what, your mortgage is being taken care of because I'm helping you make those decisions, or I'm asking the questions about what's important to you. For instance, say the mortgage broker just said, if it's all based on rates, and say they fix a rate, but the banker or say the client didn't think, hey, actually I'm actually selling this property in 6 months' time or 12 months' time, but all of a sudden you take like a 3-year interest rate or a 2-year rate, then when it comes to actually breaking the mortgage, there are fees that are incurred there. So yes, you might be able to pick the way that the rate went. The fact of the matter is you're either going to be 100% right or 100% wrong when you pick the rate, right? So for myself, I always, when I advise the clients, I tell them that, I say, hey, look, you're not coming to me for the best rates. I'll give you the best rates at the time. I can't predict the market fluctuation. Again, like I said, I'm doing something different, but you pick very easy, depending on people's situations, when there's no clear need to sell the property in the future, when it's unclear as to what their financial obligations are going to be in the future, generally, and so you can't take this as personalised financial or mortgage advice, but generally you'd split the mortgage into different portions, because in that way, if rates drop and you have say you have a loan coming off in a year's time and rates drop, then great, you fix that one again earlier. If the rates rise, then okay, you've got the other one fixed a bit longer. So every situation, you're always 50% right, and that's a pass. I'm taking a pass over rolling the dice every single time. So it's about asking the right questions. If a client said, hey, look, I'm actually selling this house 100% in 2 years' time, there's no point in taking it. Provided that's the only fact that I have, and the loan is affordable and we've done the due diligence, then it may well be that taking a 2-year rate is the best thing for the clients. They don't pay break fees in the future. Again, it's just having the right conversation. Might have been a little bit of no due diligence on the broker or advisor's end, but then again, you need that trust and just have faith in the person that you're dealing with, and then again, that's where the strong relationships come from. So I know that was a long answer.
But it was just interesting to know what's your perspective on this, because it's not very often that I get this, as a response asking about mortgage advice, and they say that they prefer to deal directly with the bank.
Well, that's the thing, is then you can either go to one bank, one product offering, but how much time do you have to build that relationship with another bank manager, and then all that happens is you get snookered in at one point, you don't have that strong relationship down the road, you don't have the time to go down the road, you don't have the energy to provide the documentation, you don't know whether or not it's going to work down the road as well. But when you work with an advisor, we've got the whole toolkit, plus we have those relationships. The advice actually de-risks you as well as a client of banks. So you become a better borrower, therefore you're entitled to slightly better interest rates as well.
Okay. And then something, just reminding me of stuff. Hey, do you deal often with people who want to buy from private sellers?
Yeah, we have.
Because what we hear from, as a feedback from buyers who want to buy, they say that the banks are very reluctant to lend money if you want to buy from a private seller.
That's right.
Have you similar experience?
Yeah, that's correct. And there are a few moving parts to that one as well, because sometimes those transactions come from properties that may not be consented.
Yeah.
If the property must obviously have code compliance, everything must be consented. The asset has to be the asset that the bank wants.
Yeah.
Then the transaction must be a registered valuation approved by the banks.
Okay.
So you do need the registered valuation if
it's a private sale.
Yeah, you must have a registered valuation. And I think that's wise as well. If you're not buying anything that's being marketed through a real estate agent, it's worthwhile that you know what the value of the property is. If you go into contract based on, and you have in there that you need a registered valuation, the valuation comes back higher than what you're buying it for, great. They call that the instant equity stuff that investors talk about so often. And it's doing you the due diligence as well. It gives you a full market report. You know it makes sense. I know people don't like parting with money, but it's worth the $700, $800 that you end up paying.
Okay, because it's interesting who will have the responsibility if something goes wrong in the transaction. Because this is where the agents and the agency comes to play, because we usually take care of that thing. And if you're selling by yourself, there's a high risk.
I think that selling with an agent is 100%. Again, it's like working with an advisor. You need to have the relationship with the agent. You need to have that trust in the agent. You need to know, the agent needs to make them feel like they're being taken care of and that you understand the market and you're seeing the realistic expectations. And when you work with an agent, you've got the whole brand behind it as well. You're going to get, I know people don't want to pay the agency fees and they feel like it's money they shouldn't have to pay. But to be honest, a real estate agent is an efficient and it's a proven marketing and sales person who's done it before. They know how to talk to people. And again, having someone be an advocate for you, again, this is if you have a lawyer, for instance, you bring a lawyer into a situation, bring an agent situation, so you have that barrier of separation between yourself and the prospective purchaser. You don't want any property developer to come up to you and start beating your price down. That's why you send an agent in to go and take the blow on the chest and say no. Vendors don't.
No, the good thing is that we don't see a lot of private sales out east. Because most of the properties are really expensive, and you don't want to risk the value of your property going by yourself. We've seen lately, I would say probably 2 or 3 properties in this area of the city selling, trying to sell privately, and then usually in 6 to 8 weeks time, they go and sign up with an agent because they see that it's really tough out there
but then
to get the best price.
Then the property's been on the market for a while, and then you get smart buyers saying, hey, I've seen this property hasn't sold.
What's wrong with it?
Yeah, exactly. I know, because that's what I ask. That's the first thing I ask on all of them.
But by all means, if you want to buy a really good property, go and buy from a private seller. That's my best advice. If you want to buy and get a good deal,
for sure,
go and buy from a private seller.
I think that's good advice.
Absolutely. Okay, then that was all for this monthly market update. We're gonna do another one probably after the new year.
I'd say so,
Or we can do one earlier if there are new changes announced by the new government that will affect both the financial and the property markets. So that's all for now. Thanks for the time and
pleasure.
See you soon.
Appreciate it.
Thank you. Thanks for watching.
See you.